Hi everyone, so we're going to analyze the leverage position of a company by looking at some metrics. So first of all, if we look at the return on asset, it's basically how much return can the company make out of its assets. And the reason why we are using the return on asset is because here for the asset we assume that the debt is going to be used to finance these assets. So here, if the return on assets ratio gives us a result that is higher than the cost of liabilities, this being that how much it costs the company to take on more debt, well, it means that it's more favorable for the company to take on more debt. Okay, so that this is going to answer this first question. Okay, let's take an example here. So the return on asset, which is like we said, the earnings generated from the debt, let's say that here it's $100 and the cost to borrow that debt is only $50. So we can see here that it's more favorable for the company to take on more debt. Okay, now here we have to go on the second step of our analysis, and we have to look at the interest coverage ratio, which basically is for every interest, how much is the company generating earnings before interest and tax. Okay, so here, if this number is above 1, what it tells us is that the company, with its earnings before interest and tax, can it pay off its interest? So here we can see that, oh yes, it can, by large. So it can pay off 11.2 times the interest that it has to pay for its debt, the current debt. Now here, the second thing is the financial burden ratio. So this is a more complete ratio because it's going to include not only the interest but also the capital on the debt. So is the company able to repay its current portion of the long-term debt for this year? Okay, the capital and the interest rate. So here we can say that since it's above 1 again, we can say that yes, the earnings are enough to pay off the current portion of the interest and the debt for this year. And yeah, it's above 1, and here it's even like it's near 4, so it can pay off 4 times the interest and the capitals on its debt. So this is good. This is a good thing to see in a company. Now here what we have are, these are liquidity ratios. Okay, so what the current ratio is, basically it's the current assets on current liabilities, and it's going to tell us if for the next 12 months, if the company, let's say, shuts down, is it going to have enough assets liquid to just repay everything it has to pay in the next 12 months. Okay, so if it's above 1, then the answer to this is yes, and if it's above, then it's even better. So here we can see that in 2018 it was almost 2 times. The current assets could have paid 2 times the current liabilities. So the main difference between these two ratios are that the quick ratio is more restrict, and it's not going to include the inventory part of the current assets. So what does that mean for us as investors? Well, it means that, let's say, for example, a company that sells, let's say Apple, okay, it sells iPhones, and let's say it still has some iPhone 3 and iPhone 4 and its inventory, okay, which is in the current assets. Well, these iPhones are not going to generate any value or revenue for the company, so taking them into account might be a bit, it's going to bias our results. And it's even the same thing if we use, let's say, supermarkets, and they have a bunch of food which is just laying in the inventory, and also it has a perishable date, so it's not going to be able to be sold. So those are like adding more current asset than it should, because those assets are not really going to generate any value. So here basically we're just excluding that, and it's going to give you a more precise answer. This being said, guys, it's really, what's important here is that yes, these are numbers, okay, but you always have to keep it in context. So let's say here, the current ratio and the quick ratio, they depend on the industry, which means that for some industry it's okay if it's below 1. It doesn't mean that a company has a current ratio below 1 that it's a bad financial signal. So you have to always compare with the industry of the other companies that are in the same sector, and that's going to give you a better result to compare your company that you're analyzing. Okay, thank you guys. If you like the video, please subscribe to see more content like this, and have a good day.